All right, everyone. Bismillahirrahmanirrahim. Assalamu alaikum. My name is Yasir Yamin, and I welcome you all in this particular session. Now, in this particular session, we are going to do one past paper which is given in your examination kit with the name of Fernanda Company, right? Now, if you ask me why I choose this past paper to discuss with you guys, because one, it is a very recent past paper. It is from March, June 2023. So not from, not very long ago, this was this period. Plus, I believe that this type of a question allows you to challenge yourself and, clarify your concepts about various topics in one go. So it's a very good question that we are going to attempt. How we are going to approach this question is something that you should learn as well. All right. So this is the learning aspect of how we do it. You need to learn how before you start learning why or what we are actually solving, right? Focus on how as well. So how do you approach a particular question in your examination? I always recommend to students that first go and read the background information, right? Background information gives you a lot of clarity and a lot of patience, a lot of, clarity in terms of setting your mind towards the question. It helps you in focusing on the right direction, so you don't focus on each and every accounting standard that when you're attempting a particular question. Once you have read the background information, you target your mindset, you target your brain towards some concepts. All right, so it helps you. So background information: Fernanda Company is the parent company of a group which constructs industrial properties. So we are in a construction business. Fernanda Company is currently preparing consolidated financial statements for the year ending 31st December 2007. Now, this is very important point for you. Your accounting year end is 31st December 2007, and which also means that your year start would be 1st January X7. Make sense? Examiner says the following exhibits provide information which is relevant to the question. Now you are going to be provided with three exhibits, right? The first exhibit is going to be about roof collapse. The second exhibit is going to be about financial instruments. The third exhibit is going to be about cash flow issues. Now, cash flow is one area which I might not be targeting fully in this particular session, but at least a substantial portion of cash flow, which is clearly related to the understanding level we are going to discuss. All right. So the first point that we are seeing right now is roof collapse. Roof collapse exhibit will describe the potential liability. It is not a confirmed liability, it is a potential liability for a section of a roof collapsing which was constructed by Fernanda Company. So you are in the business of constructing industrial properties, and a roof collapsed in a building which you constructed. Now, due to this collapse, there might be a potential liability upon you. Now, I ask you, if you were in the examination scenario, examination hall, and you saw this word, the word potential liability, which accounting standard, comes into your mind upfront? What do you guys think about when you see the word potential liability? You need to tune your mind towards a particular thing now. Definitely. It's not a confirmed liability. It's not a financial liability. It's a potential liability. Now, a liability with uncertain timings or amount, is a provision. And provisions are catered under IS 37. Absolutely right. So you are going to tune your mindset when you're reading Exhibit 1 towards IS 37 maybe. Then exhibit number 2 is going to be about financial instruments, IFRS 9. Describes the accounting treatment by Fernanda Company of a put option and a non-redeemable preference shares. So complete IFRS 9, IS 32, IFRS 7 sort of things are going to come in front of you. Okay, exhibit number 2 will be about IFRS 9 predominantly. Then you have cash flow issues. Cash flow issues is a separate topic. You study about cash flow issues under IS 7, under consolidated statement of cash flows under this course. I understand that at this point in time, you might have not studied cash flow statement of cash flows in its entirety. That's all good. But can we have a general discussion based on the general knowledge of statement of cash flows we have? Yes. All right, we'll do that. Now, this exhibit is going to describe the treatment of cash flows on the sale and purchase of subsidiaries. We are going to talk about it. All right. Now, the next thing that you should be doing when you are approaching an examination question after you have read background information, you should not be opening your exhibits right away. My advice is to always look at the requirements first. Now, if you see the requirements, the question is of total of 25 marks. But do not worry about the whole question right now. This whole question is bifurcated into various parts. And at this point in time, when you start the question, you should only be worried about the first part, which is of 7 marks. And now 7 marks are very good marks to attempt, right? You cannot leave these 7 marks. So just focus on these 7 marks as if these 7 marks will be a game changer for you, right? So part number A, we are only going to read requirement number A for now. Discuss the acceptability of Fernanda Company's decision not to record any liability for the roof collapse in the consolidated financial statements for the year ending 31st December 2007. So examiner is asking you to discuss the acceptability of Fernandez's decision. Fernanda is of the view that they should not be recognizing any liability in their consolidated books of accounts. You need to go to exhibit number 1, read that exhibit, and then discuss if not recognizing a provision or a liability is a good thing or a bad thing. Is it a right thing? Is it the wrong thing? You need to discuss that fact. All right. Once you have read the requirement, then you open your exhibit number 1. And this exhibit number 1 is definitely going to be about roof collapse. Now let's see what examiner has to say in exhibit number 1. For now, our only focus is exhibit number 1. Examiner says Fernanda Company is a group which constructs industrial properties. Repeat telecast. In September 2007, remember guys, your accounting year end is 31st December X7 and they are talking about September X7. So something has happened before the accounting year end, right? Examiner is saying in September 2007, a section of the roof in a building constructed by Fernanda Company partially collapsed. Fortunately, the entire building did not collapse. A particular roof in the entire building collapsed, and even on that particular roof, a partial portion collapsed, right? Where the construction was happening. It injured 10 people. Very unfortunate. Production, which was taking place inside the building, had to be stopped, right? Due to environmental health and safety, you had to stop the construction. However, no legal action had been brought against Fernanda Company as at 31st December 2007, as accident investigators were still trying to find out the reason for the collapse. Now, here is the whole story. Construction was going on in a building. A particular roof and a partial component of that particular roof collapsed, which you were constructing. Due to that construction, due to that collapse, 10 people were injured, right? But till this point in time, although the production was stopped, however, no legal action has been taken against Fernanda Company, as investigators were still trying to find out what was the reason for the collapse. Was the collapse due to a mistake of a third party vendor? Was it due to the actions of Fernanda Company? Was it due to inexperienced labor? It was their own mistake, or was it the mistake of Fernanda Company? Right. I ask you up till now, do you think a liability, a provision should be recognized? up till whatever we have read till now. Just think about it. Just think about it. You are in your examination scenario. Think about it. Should a provision be recognized up till now? No legal action has been taken against Fernanda company because investigators are still trying to assess what was the root cause. Now, while you are thinking that whether a provision should be recognized or not, the correct answer towards my question should be that you should revise what IS 37 actually said. So, if you remember, IS 37 had three conditions. When they were met, a provision was to be recognized. The first condition was present obligation. A provision can be recognized whenever there is a present obligation. Now, obligation is something which has to be established. It can either be established by an act of law, so it can be a legal obligation. It can be an obligation that comes out of your published policies or past practices as well. So it can be a constructive obligation as well. But in either case, it must be an obligation which is established by a certain thing. It can be established by an act of law, which in this case, I don't think, no legal action has been taken yet. So there is no legal obligation. There can be a constructive obligation if it is, there is a valid expectation that Fernanda company would have to incur compensation to the injured people and might have to pay some penalties as well. So, how this valid expectation would be created based on the past practices or based on the published policies of Fernanda, based on the reputation of Fernanda, all of these things will create a valid expectation in the minds of others, the affected parties, that there will be a compensation against this injury. Next, there must be a probable chance of outflow, right? There must be a probable outflow. Now, probable outflow, the word probable literally means that there are more likely chances of happening something or an outflow of economic benefits, more likely chances than not, right? What do you mean by more likely than not? For example, you go in an examination and there can be various scenarios. Either you are affirmed, you say, confirmed I will fail, or you will say, confirmed I will pass. Now, a very good student who has done an excellent paper, who knew everything, he would say, confirmed I will pass. A student who was not well prepared, who was not ready for the examination yet, who was, roaming around in La La Land, not listening to Sir Yasir Yamin, would say, Sir was right. I'm not going to pass this. So there can be a yes or a no. But sometimes, people like me, average students, go into an examination, they give it their best try based on the circumstances and based on the information they have available. They make a judgment call. Now, their judgment call could be, there are good chances that I might pass, right? So if you say there are good chances that I might pass, you are of the opinion that there are more likely chances of you passing than not. So there are less likely chances that you will fail, but there are more likely chances that you will pass. Now, if you have more likely chances of an outflow, then it is supposed to be a probable outflow. If there are less likely chances of an outflow, then it is a possible outflow. If there are no likely chances of an outflow, it's a remote thing, right? A remote outflow. Make sense? Third thing is supposed to be the reliable estimate. A provision can only be recognized whenever you have a reliable estimate available. Otherwise, how will you make an accounting entry? Right? Up till now, Sanya, we have one thing clear. There is no legal obligation. Now we need to see if there will be a probable outflow and if there is a reliable estimate available. Examiner says the investigators were assessing the responsibilities of the various parties involved with the report expected in February 20x8. So the actual report in which the blame or claim will be established will be published post accounting year end. So it's not decided by the accounting year end. The extent of the damage and the details of any compensation payments to be made had not yet has been determined. You cannot determine until and unless the investigation report is out. Once the investigation report is out, you will be able to determine financially how much you need to compensate the other party. If it's your fault, maybe you need to compensate more. If it's not your fault, then even you might compensate your injured workers, but not that much. You might want to claim that money from your vendor or from an insurance company, something like that. Fernanda company felt that given the current stage of the investigation into the accident, there was no requirement to record any liability in the consolidated financial statements as at 31st December X7, especially as Fernanda company felt that any compensation payable would be covered by insurance. So Fernanda company is of the opinion that up till now we cannot recognize a liability in our books of accounts because the investigation is still going on and nothing can be determined up till now. We cannot determine how much compensation would be payable, and that is why we should not record any liability. And plus, they are of the opinion since whatever compensation we have to pay, we will claim it from our insurers. Therefore, we still do not need to recognize any liability. Now, I ask you if this understanding is completely correct or not. I ask you, we need to discuss that Fernanda is of the opinion that no liability should be recognized since the investigation report is not out. We are not supposed to pay anything right now. So we don't know exactly what amount would be paying. And until and unless exact amount has been determined of the compensation that is payable, we should not be recording a liability, especially whatever we will have to pay will be recovered by the insurance companies. That is why we should not be recognizing any liability. Is this understanding correct? Now, this is a challenging question for you. Is this understanding correct? You see, this is a point of discussion. I would say, you see, as far as the point of view of Fernanda is concerned, it seems to be something, Fernanda company is not really clear of. You see, you cannot determine the exact amount of compensation that is payable to injured workers. Correct. But we are not asking you to recognize a confirmed liability. The question at this point in time was to recognize this potential liability or not. A potential liability is a provision, and provisions are supposed to be for uncertain timings or amount. So if the compensation is not adequately determinable or clearly determinable at this point in time, that is why you should be recognizing a provision. A provision is an estimate. A provision is never a confirmed liability. So the argument of Fernanda company, I should not be recognizing a liability because I do not know the exact amount of compensation, is not correct. Furthermore, the argument that we should not be recognizing any liability, especially because whatever we have to pay to the workers or the injured parties or the affected parties, all of it we will, charge back to our insurance companies. This point of view is incorrect as well. Even if you have the potential viability of receiving the claim from your insurers, then even the transaction with insurance company is a separate transaction. The if the receivable from insurance company is virtually certain, then you can recognize it as a separate receivable from insurance company. But the claim, your obligation towards the injured workers or to the affected parties is a separate transaction. It must be reported separately. So the arguments presented by Fernanda does not seem to be correct. Do you all agree with me? Do you all agree with me? The arguments which Fernanda company has given of not recognizing a liability are not validated, are incorrect. Make sense? I want an answer from everybody. That is how I assess if you're understanding or not. Right? Give me a Y or an N. Yeah. So technically speaking, Fernanda company is not of the right opinion. Make sense? But now we need to assess in terms of IS 37. So let's just roam around IS 37, guys. There is no legal obligation up till now. That is clear, right? Is there a constructive obligation? Maybe. Maybe, yes, there is a constructive obligation. Investigators are still in the assessing mode. They will determine how much to be paid. The report will be out by February 20x8. So there might be an upcoming legal obligation or a constructive obligation to compensate your affected parties. And clearly speaking, Fernanda company is ready. You see, examiner does not need to write that there is a published policy which will com compel you to make the payment. Fernanda company is ready for the investigation report. They are saying when the investigation report comes, then we will determine the amount and then we'll pay. So technically speaking, there is a policy, na? There is a policy in their mind that they will be compensating. So is there a constructive obligation? Maybe because of their past practices, they have their mindset. Maybe because of a published policy, they have this mindset, but they have a mindset of compensating. So yes, there are good chances of a constructive obligation existing. Make sense? Now the question comes, is the outflow probable by the year end? Is the outflow probable by the year end? Now, this is something which I would argue. I think the outflow up till now is possible. It's not probable. Probable would have been when at least some indication would have come to us that we might have to pay something by the investigators, right? So it's less likely chances than yes. From a numerical perspective, I think at this point in time, by the year end, there are not more than 50% chances that we will have to pay something. So the probability of an outflow is still less. It's not more, it's not virtually certain, it's less. It is there, but it is less. So I believe the probability is possible. Is there a reliable estimate available? No. Definitely a reliable estimate is not available. Can we recognize a provision? Irrespective of what Fernanda company said, you are discussing now with your examiner. Can Fernanda company recognize a provision? The answer is no. Clearly, the conditions are not met. Clearly, the conditions are not met. At least reliable estimate is not available. When reliable estimate is not available, you cannot recognize a provision. Do you all agree? A provision cannot be made. So as far as the point of view that a potential liability should not be recognized, that is correct. The arguments we discussed, right? But the outcome, can a provision be recognized? The answer is no. No reliable estimate is available. Do you all agree with this point or not? Please give me a heads up now. Please respond. Right? So, no, a provision cannot be recognized. But don't you think that we should be providing a disclosure even without financial effect? You see, under IS 37, whenever there is a possible chance of a potential liability, you should be providing a disclosure. You should be providing a disclosure. Now, that disclosure can be with a financial effect or it can be without a financial effect. If the financial effect is known, you provide for the financial effect. If it's not known, you at least you reason out the case to your investors. Make sense? So in this particular case, don't you think of without financial effect disclosure should be provided? Give me a Y or N. Definitely under IS 37, a disclosure should be provided. Now, this was the discussion that was supposed to be done on part A for 7 marks. But sir, the question is how we are going to do it? How are we going to do it in an examination scenario? I have an answer for you. This is an answer which is written by me. Why do I write answers and provide you these handouts? Why do I provide you these? The concept is, I try to provide you an answer which is written by me so that it matches the mindset level that you and I have. You might not be able to write an answer which is so crisp and clear as your examiner writes, or maybe as your, Kaplan examination kit writes, right? But in an examination scenario, nobody is asking you to match the levels of a publisher, or nobody is asking you to match the levels of an examiner. You just need to speak your heart out. And you can only speak your heart out whenever I give you an answer which matches the mindset level that you have, right? So how do you write an answer? You write an answer by starting from the two very golden words, which is according to. First of all, you brief what IS 37 says. So according to IS 37, A provision is a liability of uncertain timings or amount. This liability can be recognized whenever there is a present obligation arising as a result of past events. It can be a legal obligation or a constructive obligation. In you define, a legal obligation comes as an application of law, and a constructive obligation comes through your published policies or past practices. Then there must be probable chances of outflow. Probable chances I generally mean that the chances of an economic outflow from the potential liability are more likely than not, and a reliable estimate for the outflow of economic benefit. First of all, you define what IS 37 says. This is going to become part of your discussion, right? Then, in accordance with IS 37, if there are only less likely chances of an outflow, then a disclosure of the event and its circumstances made with or with should be must be made with or without financial effect. Now, this is part of IS 37 as well. So, up till now, whatever I have discussed, I have just done my introduction part, and this introduction part clarifies what IS 37 actually requires. Make sense? Then you start with in this particular case, in this case. Now it is application of the concept that we discussed in the above paragraphs. In this particular case, no legal action has yet been brought by the year. However, Fernanda company seems to be engaged in an assessment exercise of the potential damage and compensation to those injured. Hence, a constructive obligation may be existent. What else evidence do you need that Fernanda company in itself is engaging in this assessment? Because they might have a published policy or a reputation to protect, and that is why a constructive obligation is already there. Moreover, there are less likely chances of an outflow, that too without a reliable estimate being available. Hence, it would be correct to conclude that no liability should be recognized within the financial statements of 31st December X7. Now, I deliberately missed out a particular point, but I discussed it with you guys. You can argue you can argue on the arguments which were presented by Fernanda company, not recognizing a liability because you feel that the compensation has not yet been confirmed. That's not right. Because you will be compensated by your insurers, this argument, this is again not right. You can discuss that as well within your answer. However, Fernanda company should disclose a contingent liability as the chances seems possible. This is because a potential liability may arise when the investigation is finally completed by February 20x8. Since the level of compensation cannot be determined by the year end, therefore a disclosure without financial effect shall be made. Do you guys understand? Is it clear to you guys? I'm asking you a question. Is it clear to you guys? Very good. Excellent. Excellent, guys. Perfect. Now let's move on without any further delay. Once you are done with exhibit number 1, let's go for exhibit number 2. Exhibit number 2 is of a total of 10 marks, right? And this has been bifurcated into part 1 and part 2. It says that discuss the acceptability of Fernanda company's decision in the consolidated financial statements. The first part is to disclose a contingent liability for the estimated cost of redeeming the put options. Let me be very clear with you. Let's go above. You see, the second exhibit is going to be about financial instruments. And under financial instruments, your examiner is asking you about two areas: put options and preference shares. Now, gladly, nowadays, SBR's examiner clarifies which particular part relates to which requirement. So you are clear that for 4 marks only, the discussion is going to be on the acceptability of the Fernanda company's decision to disclose a contingent liability for the estimated cost of redeeming the put options. For now, we are only going to stick with 4 marks, part 1, put options. We'll read the other part later on. Done. Let's go to exhibit number 2, part number 1, put options. Does anybody know what is a put option, by the way? What do you mean by a put option? Very good. An option to sell something at a predetermined rate. Do you understand this point? A put option means the option to sell something at a predetermined rate, right? So whoever has a put option has the option to sell something at a predetermined rate. Make sense? Very good. It says on 1st January 20x7, on 1st January 20x7, as a result of a business combination, Fernanda company has written put options to purchase the non-controlling interest shareholding in a newly acquired subsidiary, Ronda company. This means that Fernanda company would be obliged to purchase the non-controlling interest shareholdings in the subsidiary if the put options were exercised by non-controlling interest shareholders. Sir, what do you mean? Let me explain it to you. Guys, we are Fernanda company, right? We have acquired another company, Ronda company, and we have majority shareholding. Let's say we have 80% shareholding in Ronda company. It can be 70, 60, whatever, but we have majority shareholding. Obviously, if we have majority shareholding in Ronda company, then technically 20% or whatever is left would belong to NCI. Make sense? Now, as a result of the business combination arrangement, Fernanda company has written a put option. Guys, whenever a put option or a call option is made, there will be a party who is writer of the option, and then there will be a party who will be holder of the option. So if we give right to the other party, if we give right to the other party to exercise something, if we give right to the other party to exercise something, then we are writer of the contract and the other party is holder of the contract. So technically what happened is that Fernanda company wrote a contract, an instrument, and gave it to the holder, which is NCI. And what did they give as, what did they write on the contract? What did they write on the instrument? They said, we are providing you a put option. We are the controlling party. We have acquired Ronda company. We are providing you with a put option. We are saying that if you decide that you want to sell your shares, do not sell it to anybody else, sell it to us. Simple. Now, holders, the non-controlling parties, hold the right to exercise their put options. And if they do exercise their put option, they have the option to sell it to the other party. If they do exercise their put option, then Fernanda company would be compelled, would be obligated to buy back the shares, from non-controlling shareholders. To buy back your own shares. Technically, Ronda company is yours. You have 80% shareholdings. But if NCI parties exercise their put options, you are obligated to compensate them against those shares. Is it okay? Is it okay? Guys, do you understand the case scenario? Please let me know. Do you understand the case scenario? Everybody, right? If you understand the case scenario, let us just complete the exhibit. At 31st December 20x7, Fernanda company disclosed a contingent liability in the consolidated financial statements for the estimated cost of redeeming the put options. They say, non-controlling interest might exercise their rights in future and we will have to pay them back if they exercise their right in future. And therefore, this is a possible liability that could arise on us. And that is why we are providing a contingent liability. Now, my question to you is for 4 marks only. Is this treatment acceptable to you or not? First, tell me why or N. Is this treatment acceptable to you or not? Why or an N? And maybe I know why you're not responding because I'm going to ask you, why do you say what? Right? So technically speaking, this is not a contingency. Please try to understand what a contingency is. A contingency scenario is a scenario which is so uncertain and beyond your control that you are unable to determine your obligation towards the other party. This is a contingency. Now, we have given a put options contract to the other party in writing form. It's an instrument that we have provided to the other party. Do you still think it is a contingency? Do you still think it is beyond the control of our game? Do you still think it is very uncertain? The answer is no. Guys, this is a clear cut. This is a clear cut financial liability. Don't you know what a financial liability is? A financial liability is a contractual liability to deliver cash or other financial assets to another entity. And this includes the fact that if you have to buy your own shares, if you have to buy your own shares and compensate the other party through cash or other financial assets, then again, it is a financial liability. Do you understand this or not? You have given a put option, you have written a put option to the other party. It is not a contingent liability. It is a confirmed financial liability because it is an obligation to deliver cash. So do you think is it acceptable to recognize the cost, the expected cost of redeeming the put options as a contingent liability? I would say no. The expected cost of redeeming the put option should be recognized as a financial liability, assuming that the expected cost of redeeming the put options is the fair value of those put options, and you should be recognizing those put options based on expected cost or fair value, whatever you say. Understood? Is this understood by everyone? Is this understood by everyone? Now I tell you, if you would have read this requirement very quick, I'm 110% sure your answer would not have been yes right now. Because you see, whenever derivatives come into your question, you all go like, you all just start shouting. Oh, put option, put option, put option. What will I do? Put option. Oh my God, it's nothing. Use your common sense. I always tell my students, beta, read the question slow, answer it fast. If you would read the question so slow and try to chart out something in your rough paper or in your mind that what's happening, it is a very clear cut answer for you. And you can easily answer for this for 4 marks. That is why your examiner has given only 4 marks to it. What should be the answer? Let us go in our template and see. Right? The presentation and disclosure of financial instruments is dealt under IS 32. According to IS 32, a financial liability is a contractual obligation to deliver cash or even to purchase own equity instruments for cash or other financial assets. Such financial liability shall be recognized on fair value at the date such a contractual promise has been made. Fair value in such case would be generally equal to present value of expected cash outflows on redemption, exercise of options by the non-controlling interest shareholders. Pretty common sense. Hence, in this case, Fernanda's opinion to disclose a contingent liability is incorrect. A financial liability should accordingly be recognized. Simple. Is it clear to everyone? Give me a yes and we'll move on to the next part. Is it clear to everyone? Good enough? Allah ka shukar. Let's move forward. Right? Second point. 6 marks, guys. Discuss the acceptability of Fernanda Company's decisions in the consolidated financial statements to record the non-redeemable preference shares as equity rather than a compound financial instrument. Now you need to discuss on the acceptability of the opinion that non-redeemable preference shares should be recognized as equity and not as compound financial instruments. Now, equity instrument is supposed to be an instrument with the characteristics of equity. Equity is supposed to be the residual interest in the assets of the entity after deducting all its liabilities. So whatever instrument guarantees you a residual interest in the assets of the entity after deducting all its liabilities is supposed to be an equity instrument. A debt instrument, on the other hand, Remember, a debt instrument, on the other hand, is something which obligates you to provide something. So, for example, if you have to pay fixed amount of returns, it's a debt instrument. If you have to mandatorily redeem the amount invested by the other party, it's a debt instrument, right? So, all of you, can you guys guess which topic is being tested here? Can you guys make a guess? Which topic is being tested here? Classification as equity, pure IFRS 9, right? Let's go. Let me just delete this page. It won't be necessary. Right. So it says that preference shares, in addition means separate to the other. In order to partly fund the purchase of the subsidiary on 1st January X7, Fernanda company issued non-redeemable preference shares and recognized them as equity instruments in the consolidated financial statements at 31st December X7. My first question, what do you mean by irredeemable preference shares? Now, irredeemable preference shares are those preference shares for which no buyback date is decided. For which no buyback date is decided. Make sense? Irredeemable preference shares are those preference shares for which no buyback date is decided. So, accordingly, they classified these non-redeemable preference shares as equity in their consolidated financial statements. Do you agree with this? Up till now, we have not read anything further, but do you agree with this? Classifying an instrument as equity, what instrument? Irredeemable preference shares. Yes. You see, generally, an irredeemable preference shares are those type of preference shares for which no buyback date is decided. So there is no redemption. Since there is no redemption, there is no obligation to pay back anything. If there is no obligation to pay back anything, definitely this should be classified as an equity instrument. And we usually classify irredeemable preference shares as equity instrument always, right? Then your examiner gives a twist. The preference shareholders will receive an annual fixed cash dividend of 5%. So first, they are irredeemable. Irredeemable means that they should be classified as equity. Then there is a point that they will be paid fixed dividend of 5%. Fixation of dividends doesn't represent an obligation to pay out some obligation to deliver cash every year. Don't you think this represents a debt characteristic? Yeah, this represents debt characteristic. So it's a debt now. Then it says, and a participating dividend, which was 7% of the ordinary dividend. Now they are saying they will be paid a fixed 5% dividend. But just like ordinary shareholders, they will have the option, they will have the opportunity to get a participating dividend, which is 7% of ordinary dividend. This seems to be equity because equity holders are always entitled to additional profits. Equity holders, you have known, na? Ordinary holders are those type of holders who are risk takers. They get to enjoy the additional amount of profits whenever the company earns. So in this case, they have participative dividends as well. So this depicts equity. They are saying Fernanda company stated that the instrument had the characteristics of equity capital as it provided for participation in the future income of the company. Now there are arguments against it. Now, Fernanda company is saying I should be classifying this as equity. I should be classifying this as equity because there are 2 points which favor equity. First, they are irredeemable. Next, there is participation. And another person comes. That person says, whoa, You are saying 2 points say that this is clearly an equity instrument, but there is a fixed dividend. There is a fixed dividend. So at least there is some portion of debt element included as well. Don't you think? Don't you think? Tell me, guys. Yes, we agree there is equity, but there is some sort of confirmed debt component, confirmed obligation to deliver cash as well. Mixture of both. Move on. Fernanda Company concluded that compliance with IS 32 financial instruments presentation would be so misleading that it would conflict with the objective of financial statement set out in the conceptual framework. Whoa, whoa, whoa. Where is this coming from? Guys, there is clearly two things into this instrument, debt and equity both. It's not a matter of judgment. It's clear. Fixed dividend with irredeemable, fixed dividend with participation. Clearly, guys, this is a compound financial instrument. Clearly. Compound financial instrument is treated under IS 32. You segregate the debt component and equity component and do whatever was told, right? Now, Fernanda Company is saying that if we follow IS 32, it would be so misleading that it would be against the objectives of conceptual framework. Fernanda Company considers this classification of preference shares to be equity rather than a compound financial instrument. No, you see, they know that this is a compound financial instrument. They are saying we will not classify this as a compound financial instrument. Logically speaking, think if they classify this as a compound financial instrument, then they will have to identify a debt component as well. And that would not be taken as a good thing in your balance sheet, right? Now they are saying we are not in favor of what IS 32 says because we are going to claim exemption from IS 32. Where did they get this exemption from? You will study in ethics area as well. But IAS 1 says that an entity should follow all IFRS. IAS 1 provides that an entity shall follow all IFRS without cherry picking. All right. Now, where IAS 1 says that a company should follow all IFRS in true spirit, IAS 1 also says that in extremely rare circumstances where following a particular accounting standard would be so misleading that it would be against the objectives of preparing a financial statement, there is an exemption that you might decide not to follow a particular accounting standard. But it also says IAS 1, this will be in extremely rare circumstances. Practically speaking, I haven't seen any circumstance where a departure from IS or IFRS is exempted due to the conditions, due to this exemption of IS 1. I've never seen it. I have never seen it. Now, what they are Fernanda Company saying? You see, we have read something in IS 1 and it allows to exempt, it allows not to follow any particular IFRS if it's misleading. So we are not going to follow IS 32 compound financial instrument. We are just claiming our exemption. No, this exemption is not available to everybody. This is an extremely rare circumstances. A hyperinflationary environment maybe, or an import restriction environment maybe, where following a particular accounting standard would be misleading to your shareholders. There you decide, okay, we are going to departure from IS or IFRS. We are not going to follow a particular IAS. There IS 1's exemption is allowed. I'll give you an example just to explain this. In Islam, it's allowed to, maybe if it's the matter of life and death, you can drink something which is haram as well, right? If it's a matter of life and death and you're going to die anyway, so Allah Ta'ala allows us to, even go for something which is haram in normal circumstances. Now, if somebody comes and says, I'm going to consume this particular thing. Let's say I'm going to consume blood of a human being. I'm going to drink blood and I'm going to claim the exemption which was given by Allah Ta'ala at that point in time? Would you call it a sane person? Are you in your senses? In extremely rare circumstances, Allah Ta'ala allowed that if you need to save yourself, you can, even drink XYZ and just save yourself. But would you think in a normal circumstance anybody would do that? No. Likewise with the hair. IS-1 provides you an exemption, but nobody claims it. You cannot just come up and say, I'm not going to follow IS-32 because I feel this is against conceptual framework. How can you explain that this is against conceptual framework? The IS-32 clearly requires an instrument which has debt and equity components both should be classified as a compound financial instrument. If you classify this as a compound financial instrument, what's the matter? So is Fernanda company correct in this opinion? Is the option provided by Fernanda company to just classify it as equity, is it acceptable? The answer is no. If you argue that, sir, at least 2 points favor equity, then at least 1 point favors debt as well. An examiner has clearly written that it can be a compound financial instrument. It is a compound financial instrument because you have promised to pay a fixed dividend. It's not something about judgment, it's written. You have to pay a fixed dividend. So it's a compound financial instrument. Make sense? Make sense? Now, how do you go about writing an answer, whatever we have discussed? Let's read it out. So I just first clarified, you are going to learn this exact same line when you study the chapter of ethics. So don't worry about it if you have not studied till now. It will come into your ethics chapter. According to IS-1, in extremely rare circumstances where following the principles of where, this is where, by the way, where following the principles of IS or IFRS would be so misleading that it would affect the quality of financial statements, a departure from IFRS is allowed, but with detailed disclosures of the nature, reason, and its impact. However, such a case seldomly arises. According to IFRS 9, maybe IS 32, an equity instrument is a contract instrument which represents a residual interest in the assets of an entity after deducting all its liabilities. Moreover, a financial liability is a contractual obligation to deliver cash or other financial assets to another entity. According to IS 32, a compound financial instrument contains the element of both. This is exactly what IS or IFRS tells us. Replicated it. Done. Then I started with the point in this case. Generally, irredeemable preference shares meet the definition of an equity instrument since there is no obligation of redemption. However, the existence of a promise to provide for a fixed cash dividend of 5% per year reflects a financial liability. Moreover, a participation in additional income from the company again supports the existence of an equity element for the holder. I discussed the entire scenario. If you think, if you think clearly, all of this is information from the question. I'm just using it to explain my perspective, right? So you use the question, and that can only happen when you read the question slow and answer it fast. Hence, a fair representation could be to disclose the instrument as a compound financial instrument. Here, both debts and equity elements need to be segregated. The carrying value of the instrument can be shown as a liability, and only the residual delta between the fair value of the instrument and the carrying value should be recognized as an equity component. Hence, Fernanda Company is incorrect in its proposition to classify this instrument as equity only. Make sense? Is it clear to everybody? Is it clear to everybody, guys? Done? Very good. Now, guys, we are only left with the C part, right? Unfortunately, at this point in time, we cannot attempt the C part fully. We cannot attempt the C part fully. I am just going to do this particular bullet point here, which is discussing the issues of Fernanda Company's treatment of cash flows for the year ending 31st December X7. And I'm just going to briefly discuss one particular area. So this is exhibit number 3. And I'm not going to discuss this whole exhibit because you might have not studied the whole content up till now. So I'm just going to study this point. All right. Just listen to me, and it's pure common sense, right? And I'm not going to even read the answer that I've written. Let's just discuss it casually. All right. On 31st December 2007, Fernanda company sold its entire holding in a subsidiary company, Interactive company. So Fernanda company had a subsidiary, right, which was Interactive company, right? And now it has been disposed of. Fernanda company had loaned $3 million to Interactive company on 1st April 2006. Remember, the loan Fernanda company gave to Interactive company was in past years. And you are standing on 31st December X7. And this remained outstanding even after its sale. So previously, before the sale of subsidiary, it was an intra-group loan, right? And after the disposal of subsidiary, the former subsidiary did not pay back us the loan, did not pay back us anything. But now this loan should be classified as a third party loan. For us, it will be a third party receivable, and for them, it will be a third party payable. Do you understand this point or not? We gave a loan to our subsidiary on 1st April 2006. It was an intra-group loan. During consolidation, it would always have been knocked off. But now, once the other entity has been disposed of, this is a third-party arrangement, right? And this is a third-party arrangement. For me, it will be a third-party receivable. For them, it will be a third-party payable. All right. They are saying as a result, the loan to the former subsidiary was recorded in the consolidated financial statements as at 31st December X7. Previously, during consolidation, this loan was never recognized. It was knocked off. But now, as a result of this disposal, now this loan is shown in your balance sheet. Is this okay? Is this okay? Does this make sense? Tell me, does this make sense? Now it's on your balance sheet. Obviously, it's not eliminated anymore. Therefore, Fernanda company presented the full amount of the loan as a cash outflow in its investing activities in statement of cash flows, despite the fact that there had been no cash movement on the loan during the period. I'm just asking you one simple point. Is this correct accounting treatment or not? Is this correct accounting treatment or not? They are saying, you see, the loan was not in our books previously, consolidated financial statements. Now it will be in our consolidated financial statements. So it is an additional thing which is now coming as a receivable in our books. Now, from now on, everybody who sees our balance sheet will see that there is a loan which has been given to a third party company now. So we are technically, in order to correspond to this information, we are showing this loan as an outflow in investing activities in this year's statement of cash flows. Is this correct or not? Use your common sense. Guys, even if you are not well versed with the concepts of consolidated statement of cash flows, even then use your common sense. A statement of cash flow is a statement which talks about cash flows. The loan was given in 20x6. This is 20x7. If there is no actual movement, if there is no actual movement in cash flows during the year, it cannot be shown in statement of cash flows. Do you understand? The loan which was given to your former subsidiary would have been part of their net assets at the disposal date. Just listen to what I'm saying. The loan, the third party loan, the liability of the loan would have been included in the net assets of the subsidiary at disposal date. And accordingly, this loan would have been adjusted as part of the calculation of gain or loss on disposal of a subsidiary. You will understand when you study disposals of subsidiary and cash flow as well. But common sense wise, is it correct to show this as a cash movement in your cash flow? The answer is no. Do you all agree? Do you all agree with this? Common sense wise, is it okay to you? I just wanted to touch upon this particular part so that you don't feel left out. But even if you use your common sense, this is pretty much clear. Uh-huh. Clear? Agreed? All right. This is it. I'm not doing this part anymore. 8 marks. 8 marks. I've actually touched upon at least quite a few marks here. Maybe you'll get with this information which I've given you, you might get 3-4 marks clearly. So the rest of the part I'm not doing because you haven't studied that portion yet. When you do, we will discuss about it as well. All good? Done, dusted? Should we call it a day?